All right, we're going to get started here in just a few seconds. If anybody wants to give me a sound check by typing OK, or you can hear me in that little chat message down below the window, that'd be great. Yep, okay, good. Thank you. Appreciate it. All right, let's get started here. I'm going to try to keep this to about 30 minutes or less, hopefully, and then there's going to be a Q&A session afterwards. And if you haven't figured it out already, on your box there should be a chat feature where it says type message here. You can ask questions anytime throughout the webinar. I'll just have to scroll back and just go back and answer them. But in general, if you want to keep them to the end, that'd be great. So to begin, my name is Scott Smith. I am the Senior Technical Analyst here at Briefing.com for just over 10 years now. I post most of my trading comments and trading calls underneath the Briefing Trader service under Blue Chip Trader, or BLUEX is the acronym. And essentially, my style of trading is a swing trader. And I focus specifically on leading stocks. The term blue chip originally comes from casinos, where the blue chip is usually the most valuable chip that everyone strives to get. It's the most, not to say expensive, it's the one that's worth the most. So when blue chip is applied to the stock market, it's also considered to be the best of the best, the most valuable stocks that are out there. And those are really kind of the names that I want to be focusing on, the ones that everybody always wants and the ones that everyone can always rely on. They're usually profitable companies. They're usually really strong companies in uptrends. They're usually have some sort of institutional sponsorship to them. And so that's basically the focus of today's webinar, is going to be trying to identify these swing trading setups in these leading stocks and in these leading sectors that are really outperforming. So the first thing I want to start off with is, what is swing trading? In my mind, and the way I trade, is I'm trying to capture the momentum over a period of 3 days to 3 weeks. Sometimes it's a little shorter, depending, it could easily be 1 day or a couple hours, depending on the volatility of an individual stock, or if there's a certain news headline out, or how the certain market conditions. But generally speaking, I want to capture that momentum or capture that trend over a significant number of days. And in order to do that, you have to focus on bigger picture trends. I always look at the weekly charts, and then I look at the dailies. I rarely drop down below a 60-minute chart, unless I'm specifically looking for a specific day trade or a scalp of sorts. But that's a whole different webinar altogether. But for swing trading purposes, you never really want to go below a 60-minute chart. Why? Is because it's going to give you the patience that you need. It's going to give you a clearer picture. You're not going to feel this immediate rush to go out there and buy a stock. You get caught up in too much noise when you start looking at smaller time frames. So by focusing on the bigger picture, you're going to be able to sit with more positions, or just give everything time to work out in your favor. I do tend to trade smaller and medium size when I swing trade, usually just a couple hundred shares. And because I trade smaller size, I do tend to use wider stops. And as a result, I have a much higher percentage of wins because I'm giving stocks and the price action time to move around and time to establish new support, time to establish new resistance, and to basically give it a little wiggle room and work in my favor. The average true range, if you don't know what that is, basically it takes a measurement of the average range over the last couple of days of a stock. Usually the default on most charting packages is 14. I usually tend to use a 5-day ATR or a 10-day ATR. But generally speaking, it's going to tell you if a stock's daily range over the last 5 or 10 days is $2 or 50 cents or $8, in the case of higher price stocks like Google or Priceline or Apple. And that's usually a general good place to start for identifying where your stops, or how wide of a stop you need to have in place. It's also really good at establishing a profit target of where you almost want to scale out. So if an ATR is, say, $2.50, you pretty much want to be risking $2.50 underneath the day's low or the prior day's low. And then when it moves $2.50, which is the normal range for that stock, you almost want to start scaling out of your position. Take a little profits off the table. And so generally that's a really good rule of thumb. You're going to see me follow that through a bunch of examples over the next couple minutes. So basically, as a swing trader, I'm not looking to hit home runs. I'm just looking for a steady flow of medium to larger gains on swing balances. And the good thing about it, like I just mentioned with ATR, I usually do have some pretty well-defined risk parameters before I even get in the trade. Like I said, I can just look at an ATR and know immediately what I'm about to risk. And again, I'm just going to go over some more examples in a few minutes to show that. So the best opportunities, in my experience, is always going to be among leading sectors, and it's going to be those leading stocks in those leading sectors. So essentially, you're looking for the cream of the crop and the above-the-line stocks, the ones that are truly pacing and taking the market higher. I do use technical indicators, and another thing that I've just noticed over the years is that technical indicators, you have to really understand that they are exactly that. They are just an indication of the current price movement. They're not an actual signal. If you try, I'm sure if you've ever tried to actually take a signal off a technical indicator, like a stochastics or RSI or MACD, you're going to pretty much be subject to failure 50% of the time at least. But if you kind of just use it as a conceptual framework to develop part of your analysis and just say, all right, this is oversold or this is in an uptrend, and then you can frame your entries around it, you're going to see that you're basically putting the odds of success much more in your favor. And just going forward too, you're going to see a couple charts. RSI 14 I have on some of them, RSI 5, you can see stochastics 5, but just generally speaking, it all pretty much signals the same things no matter what parameters you use. It's really just a matter of how you visually want to see things. But just in case you didn't know, the RSI 14, when it's trading around the 50 midpoint, it's usually pretty comparable to an RSI 5 in the oversold area. And it's also usually synonymous with the price action itself trading around the 20-day EMA. So whether you like to use indicators or not, RSI or not, you can always just use a moving average, and you just know that you kind of, all these things are all kind of reflecting the same exact signals. So where to identify the strongest sectors and the strongest stocks using Briefing's site. And I'd say about 4 or 5 years ago, 2009, I helped develop some focus lists that we can place in front of subscribers to really show them some of the strongest leading names that are out there. And we came up with three focus lists. The one that I particularly am always following is the liquid momentum. Those are they trade much higher volume, over 1 million shares, and they have strong fundamentals, earnings growth, etc. And they're also most of the time in established uptrends, or at least outperforming in some way, shape, or form on the charts. We also have the emerging growth focus list, which focuses much more on the smaller to mid-cap stocks that are out there with a strong fundamental and strong relative strength component to them. And we also have the value focus list, which that's also incorporates a strong technical, but it also has a not a cheap, I don't want to say a cheap valuation to it, but they're companies that where management is buying back their stock, and dividends have been steady and in some cases even growing. So the stock's outperforming, and you have this buyback of common shares, and you have this nice dividend paying. So it's usually they're a little bit slower moving, the value names, but they're also really, really good trend following stocks and stocks to watch on pullbacks. Now, the one thing I've noticed the last couple of years with these focus lists is that we do break it down, and we do show the industry or the sector that each stock is trading in, and that's a key component to me. So each week when these lists are updated, I go through and I just kind of glance quickly at these industry sectors, and I want to find a theme. And I can see right here off the top of the bat, I just have biotechnology, pharmaceuticals, biotechnology. The semiconductors is here. I see two other semiconductors here. And information technology services. I mean, so I kind of can see already that I want to be involved in biotechs, pharmaceuticals, semiconductors, and some sort of information technology services, which I think translates into a software kind of stocks. So software, semis, and biotechs are really where I want to be. This list over here on the right, this is going to be a new feature that I just don't go looking for it on the site. I'm just going to add it next week on the Liquid Momentum Focus list. And it's a new scan that we came up with just to kind of summarize and make everyone's life easier to find those strongest sectors. And again, you can basically see that it's mostly healthcare, aerospace, and then we basically listed a couple of ETFs here in case you're interested in looking at those ETFs. But when I start to see these sectors and this theme across the emerging growth stocks and the liquid momentum stocks, and even amongst the value names, I start getting my list together. I start grouping things together, and I start looking at the charts of all these names, and I'm trying to look for particular types of patterns and setups. And on this slide, you can see that the highest probability setups, and I guess this is kind of a general thing, but essentially we're looking for breakouts, out of strong flat bases or consolidations, or maybe multi-month ranges or multi-week ranges. And they're usually pretty identifiable because you can usually draw a trend line of some sorts, either off a recent swing high or monthly high, weekly high. And then usually a flat base of sorts where it's going to have a really narrow range developing, or a series of doji patterns. Dojis is a candlestick pattern where the open and close is very similar to together. It could be open and close can be very similar on the week. It could be open and close similar on a month, or even on a daily chart. And that usually means that the stock is basically resting, and it's pending. It's basically this bigger trend following day is usually going to be following soon after, because while its stock is like dormant right there. So those are really good patterns to look for. Pullbacks, usually I want to focus on stocks that are in uptrends already, and they're basically pulling back to either a key support zone, a key moving average like the 20-period moving average, 50-day period moving average, or just a general trend line that you can draw off recent lows. Gaps. Gaps are also pretty important to track for swing trading probabilities, high probability setups. A lot of people like to shy away from gaps or fade gaps, and I don't blame them. It's tough to always commit money and capital knowing that a stock is up $5, $6, $7 from where it was trading the day before. But you have to kind of understand the sentiment and what the thinking behind a gap. There's usually a massive shift of mentality when gaps occur. People who are short have to now cover, and people who aren't long now have to reevaluate everything and put new valuations in. There's a whole massive shift going on with gaps, and it could be due to earnings or upgrades, maybe just company-specific headlines. There's just a whole massive shift going on. I try to stay away from trading gaps the day that they actually happen, and I've noticed that if you wait maybe with a couple days after an actual gap, there's actually a much better lower risk, high reward entry that's going to set up for you to get in if everything holds true. And again, I'm going to show a few examples of that in a moment. So these two charts here. So on the left we have the pharmaceutical ETF PPH, and on the right we have one of our leading stocks from the liquid momentum screen is Allergan, AGN. And I just want to show that, without getting into too specifics, that even the most basic of technical analysis tools, you don't have to be an expert at this stuff. It's all about being patient and waiting, for the right setups. So here we have the pharmaceutical ETF here, and you can see that it's outperforming the S&P really, really strong so far this year, and obviously the relative strength line is trending higher. However, even though when it was trending higher, the sector itself took a pretty hard hit with the rest of the market in late January, which is just really interesting, but yet the relative strength held up. That to me is a signal right off the bat that I want to start focusing on. RSI 14 began to drop down to the midpoint, which again that would correlate to some shorter indicators like stochastics 5 going into oversold area. And when I start seeing that, that's really when I start perking up. I really want to start from a swing trading basis, looking deeper into these names and focusing on either an entry point for the actual ETF itself, or I want to start going through the leaders, that are still holding up really, really well. And sure enough, Allergan was one of these names on our list. And you could also see that over here on the right side, relative strength was holding up. Price had pulled back nicely to the 20-period moving average. It chopped around a little bit, as stocks usually do. It's very rare to see stocks just bounce right off a moving average. Technically, there's nothing special about a moving average. It's just an average. It's support and resistance levels that really have to be focused on. But as we all know, too, support and resistance levels are usually broken or probed or tested or challenged, and there's some sort of shakeout movement that happens before price can actually resume higher. But generally speaking, I knew at this time that you kind of want to be involved, or you want to start keeping an eye on these types of setups. RSI 14 dipped below 50, stochastics 5 became oversold. The MACD histogram started to edge higher a little bit here in February, and once it cleared the prior week's range or the 5-day highs, you knew that you pretty much had a high probability entry point going on here. You also had the sector itself confirming the move, so you kind of had a choice of either going for the individual stock or going for the ETF at that time. The next two charts here, we have the Aerospace and Defense ETF, or the ITA. Really strong performance over the last couple months. So you're looking at stocks like Boeing, I believe, was in our liquid momentum focus list. It's one of the higher priced in the group. Interestingly enough, the value focus list also contained Raytheon, Northrop Grumman, 3L, level 3, I think it is, Excelsius, and I think this is Spirit Aerosystems. But these were all on our value focus list at that time, while aerospace was really showing a strong performance here. And again, just using basic technical analysis, we already know it's in a strong group, but as a swing trader, I'm basically looking for mostly pullbacks in context of the trend. And some of the best ways to focus on is RSI 14 came around the midpoint, 20-period moving average was in play, stochastics were oversold, and it's not to say that every single is going to be perfect. I mean, if you went in and bought there, you got chopped around, and maybe you had to take your loss here. But you keep these things on the radar based on their relative strength and based upon previous support levels and previous lack of breakdown in the other indicators. Again, nothing about trading, if you've been trading for more than, say, a week, you realize that nothing is perfect. And it's all about indications. It's all about finding the right zone, finding the right price level, and managing your risk accordingly from that zone and from that price level. If you go too hard or too much into thinking that you just bought a higher high, you're just going to be too subjective to. You're going to subject yourself to too many whipsaws. So again, here you could kind of see that it's set up for a pullback of sorts. Again, here in December, as well as in early January, and here in late January, early February. And whether you trade the ETF or whether you actually went after one of these names and just kind of focused on the movement, if you focused when the ETF, when the whole sector itself was making a bullish move and resuming its uptrend, then you can, with confidence, jump in to the bullish move on an individual stock. This is really nice here too. I like to point out that late January, while the sector was getting hit and the rest of the market was getting hit, you could start to see that Raytheon's relative strength held the 50-day moving average right here and actually finished the month strong. So those are kind of signals you really want to pay attention to and watch out for. So now why I am definitely focusing more on the bullish aspect of all of these leaders. And I'm going to try to prove a point here. I know a lot of it has to do with broader market conditions, obviously, but we've had these focus lists for about 4 to 5 years now, and I've back tested different strategies, simple stuff, just like we've just seen from RSI 14 trading above and below 50, or stochastics, short-term stochastics 5 or 14, or RSI 5 being oversold and rallying out of them, or just simply doing a trend following method of these leaders above their 20-period moving averages or above their 50-day moving averages, and they do very, very well in that regard. The only time they really seem to kind of suffer is when they're trading below the 20-day moving average, when they're trading below the 50-day moving average, which are just warning signals in themselves. And you should kind of treat that as almost a general rule of thumb for most of your stocks and most of your positions, especially for short-term trading. When leaders aren't behaving bullishly like they're supposed to, if they're not holding support levels, if they're not breaking out of bases and showing follow-through, those are all red flags. Those are all warning signals that you have to be aware of. You either have to adjust your position size, maybe consider hedging them with a covered call of sorts, or just tightening up your stop, or just taking your profits and getting out of it. You just have to kind of look at the market each day and track your stocks that you were involved in. But to prove a point, I did backtest, breakouts versus pullbacks, and this first backtest here, it was just basically buying a daily close above the prior week's high, and then selling the next daily close below the prior week's low. So you can see it's about just over 50% here. Don't get caught too much up on the profit and loss number. It's just 100 shares of stock, and it was applied to this week's liquid momentum focus list, the top 50 stocks. But what I really want to kind of look at is these two subcategories right here, is the percentage of winners and the profit factor. A profit factor is essentially the average winners and the average losses, the ratio of average winners to average losses. So essentially, for every dollar that you risked, that you lost, you made $1.34. So that's okay. On 50% of the trades, assuming you took this looks to be about 70 trades. In the last month and a half. But now on the flip side of things, I just reversed the signals, and I said, let's buy a daily close below the prior week's low and sell the daily close above the prior week's high. And you can see that the results are just much, much stronger. You're getting about 72% chance in winners, and your profit factor, or your ratio of average winners to average losses, is for every dollar that you lost, you made back $4.56 on just about 70 trades or so. So again, this is just reinforcing the fact that the leaders, remember, our focus lists are strong fundamentals and strong technical relative strength. These are the leading stocks. These are the best of breed. So to buy weakness in these names and buy them on pullbacks, you're going to see a significant upside bias to them. It's really only when they start breaking down aggressively below the 50-day moving averages that I would basically try not to trade any of these stocks. Stocks below the 50-day moving averages, or at least down there for a couple days, tend to roll over or get a little bit weaker. Below the 20-period moving averages is okay, but again, the biggest takeaway from here is that you want to buy dips among these leaders. Or, if you're a breakout trader and you like the patterns that you see, maybe just hold off on trading full size on breakouts, just because they seem to be more of a 50-50 type of event, as opposed to actually buying pullbacks in them. Here's an example recently of PANW, or Palo Alto Networks. And this is basically the scan that I just showed of where the prior week's low was probed, and I waited for this particular backtest. I waited for the daily close to actually close back above that signal, back above the prior week's low. So back here in January, you could see that it was a nice takeout of the prior week's lows. The daily close the next day closed back above the weekly lows. Nice long signal. It's a leading name. I think it was ranked back in January, ranked within our top 10. And now recently it's actually been ranked number 1 the last here in February. Or you can just wait for the breakout itself over this $58 level, which would have been the following day. Either way, this is a type of pattern or a setup that you just kind of want to be looking for. And then you could have just sold up here. It looks like it was like $3 higher. And then here is the next signal. A low took out a prior week's low, and the daily closed back above it. Again, this is what you're going to see amongst your leadership stocks. Even one-day dips or these things where you think the trend is over and they're rolling over, they're going to be bought up pretty quickly, especially if the broader market's still in an uptrend or the sector itself is still confirming signals. You could have also waited for the breakout as well. Me personally, on the Briefing Trader service, I like to buy pullbacks a lot. I'm not much of a breakout trader unless it's a significant pattern that I'm looking for. But for the most part, I'm going to be buying pullbacks to key support areas or on signals that they're actually holding those support areas. And then when I see the breakout, I want to be scaling out of profits. It's just the mentality of trading that I've been applying for the last couple of years, and it works best for me. You can see here the next signal was in late January. Didn't work out as well. I mean, the next day it kind of failed a little bit. Again, this comes back to giving stocks enough time, enough room to work out in your favor, especially from a swing trading basis. You should be trading just small to medium size. You should not be risking your whole account on this type of stuff. You should even be considered trading the options on some of these stocks. I do like to trade the options on a lot of the liquid momentum names because they are the higher volume. They have more liquidity to them as opposed to like the emerging growth stocks, which seem to be smaller cap names. But the liquid momentum focus list, really a lot of good option candidates here. And also trading options, you already know your risk, so to speak, by putting up the cash right there, and it allows you to sit and not be so concerned on a day-to-day basis of the actual price movement itself. Just something to look into. But had you taken your loss here on this breakdown again, you could see that this low here primed the prior week's low, and it should have set up for another buy signal here on the reversal, and then you caught this nice big extension higher. Just the parameters here are a little different for my sell signals. I think I was using an ATR, so it didn't trigger didn't trigger the maximum sell signal. And again, I'm just going to kind of hammer this home of why you should be focusing on buying weakness in these leadership stocks. So I did kind of do another back test using just RSI 5, and I said amongst leaders, if the RSI 5 goes above 70, meaning the stock price action itself is strong, usually breaking out above a 5-day high, to buy it, and then sell when it breaks to when RSI 5 is below 30, or it's usually in correlation with a 5-day low. So you can see the returns, obviously buying the 5-day high, so to speak. The percentage of winners is much smaller, 42%, and the profit factor wasn't anything to be bragging about at all. Now if we reverse that and said, let's buy the rallies from below 30 and sell when the RSI 5 is above 70, you can see that the percentage of winners shoots up to 77%, and the profit factor is just off the charts. At for every $1 you lost, you basically made back 15. Now, granted, this is a little skewed because there are some higher price stocks like Priceline and Google or amongst our liquid momentum leaders, but essentially, hopefully, you're getting the point that buying the pullbacks in these leaders is really a nice strategy to be focusing on. Here's an example of Gilead. So biotechs have just been absolutely on fire for almost a year now. And this is the RSI 5 strategy. And the blue line here is the 50-day moving average. And this, again, usually want to focus on stocks that are trading above the 50-day moving average. Doesn't mean I won't take the signals if they're below it, but I want to definitely see price action get back above the 50-day moving average on these leaders as quickly as possible. So you can see here, this goes back to October. Gilead's been on our list along with Biogen, Jazz Pharmaceuticals. There's probably about 8 or 9 stocks that are just leading this sector the last few months. So definitely a key part of the core trading strategy. And again, another thing to focus on too, like I said earlier, technical indicators should not necessarily be used as buy and sell signals. And what I mean by that is this strategy right here is waiting for the RSI to actually come out of its oversold level, because there's definitely going to be times where if you just start accumulating and buying on the very first dip below the 30 oversold reading, it can go down another day. It can go down another day. It can gap down on the third day against you. It can be just anything go wrong against you. So it's always best to wait for that confirmation of maybe back above a trend line or a pullback or back above a previous day's high. But generally speaking, these are just the times that you want to be focusing on these pullback setups is usually when some sort of indicator is becoming oversold or RSI 14 is in the midpoint. Now, for shorter-term traders, or if you come across a stock, something like I don't have it up in front of me, but I think the stock is Illumina, is ILMN, and Jazz Pharmaceuticals, JAZZ. These stocks, they don't seem to pull back at all in the daily chart. They just seem to be, sometimes you get these stocks that are so strong and so powerful, and they just go into these multi-day, even multi-week uptrends, and you can't even find a pullback to even jump on board. Those don't necessarily mean to dismiss them. All it means is that you now have to drop down to a smaller time frame. And a strategy that I've backtested on a lot of those stronger names that don't pull back on the daily is just a 60-minute stochastic. And again, you're not buying the actual dip of stochastics into oversold territory. You're waiting for it to actually confirm rallying out of it. And so when it dips below it, it should be on your radar. When it starts rallying out of it, that's when you want to start focusing on it. Hopefully it's breaking above or holding along a key daily support level, maybe a really short-term moving average like a 5-period or a 10-period, or a trend line of sorts. But it's just a different strategy to start deploying. Since January 1st, I took this week's top 50 stocks on the focus list, and I just ran this scan specifically, and you can see that there were 82% winners. Had you taken all 180 signals on a 60-minute chart with about almost a 4-to-1 profit factor. So you can see it's a very profitable strategy. I switched it over to also use RSI if you don't like using stochastics. It's just a standard RSI 14, and when it rallies from below the 30 level on a 60-minute chart, and then you sell when it's over the 70 level, again, same group of stocks that I tested it on, you can see it's about 74% percentage of winners with a 4.41 profit factor. Here's an example of a couple of them. So Splunk is a leading software stock on our focus list within the top 10, if I recall. And you can see here in January, here's the stochastics, and just really came off the high, went from about 83 to 73. What's really nice is you can just kind of apply classic technical analysis, and if you just look to the left side of the chart, you can see that there was a bullish gap here on the daily, which you can see held on the 60, and the price action was coming right down into it. So this is the kind of stuff that I really like to see. I like to see the bullish gap on the 60-minute chart, 72, 73 area, oversold 60-minute stochastics. Once it starts rallying out of that, I'm always going to be willing to take some sort of trade. Entry around 74, mid-74, 75 area, and you're pretty much risking somewhere around $2.50 to $3 as long as this gap support holds. Price action did dip the next day. Again, you're on a 60-minute chart, so you're definitely going to be more prone to whipsaws. But this is where that scaling out mentality incurs, because there was about $1.50 to maybe scale out of before it pulled back a little bit. And then if you held on a little bit longer and gave it the room that most of these stocks need, you could have probably caught about a $3 gain. It did set up again in early February. This time the stochastics were oversold. Price action did not get down as low as it did. To me, that's a bullish divergence in price. And you could have just jumped aboard, and you had a much smoother trend with the rest of the market rallying here in February for about a $5 or $6 gain. When it got oversold, you got out. I would recommend taking partials. That's a huge component of my strategy on Briefing Trader. I take partial profits, and then usually I let some sort of runner or a trailing stock balance on the balance, just to kind of capture the rest of the move without me. It's like free money at that point. RSI, you can see the same thing. You can use a confirmation of both of them. Again, a lot of these things that I've shown you so far, where the price action is below the prior week's low, you can combine that with the 60-minute stochastics. You can combine it with the RSI 5 daily being oversold. These are just all high probability setups that I really tend to focus on these leading stocks. It's not until the ones I would actually back off on are the ones that have specific headline news. If there's earnings out and they gap down, avoid them. Don't even try applying a stochastics or RSI to something that's gapping down in earnings. Even if an analyst comes out and downgrades one of these leaders, there's something going on there. You're going to see too much of a massive sentiment shift that there's a chink in the armor. There's something wrong with these leaders that somebody sees, and whoever's been sponsoring these, whether it be an institution or a big fund, they're adjusting their position size. So you really kind of want to focus. I prefer to focus on more of the non-news, non-headline driven stocks for this type of strategy. But then on the reverse of that, I always want to focus on the positive news, the upgrades, the ones that react, that gap higher on earnings or some sort of news, company news. Here's Jazz, and like I said, the daily chart of Jazz hasn't pulled back in a few weeks, so you kind of have to drop down to a 60-minute chart. And again, the oversold conditions on a 60-minute tend to be very, very, I wouldn't say reliable, because they do tend to whip around a little bit because it is an intraday chart and it's subjective to the overall market sentiment of that day. However, if you give it enough room and you position yourself accordingly, you can really find and capture a lot of winners. Trading gaps among leaders, again, this goes back to leaders should act bullishly. You want to see bullish gaps. Don't try not to hesitate saying, oh, the stock's overbought, gapped up too many points. If I don't like to trade the actual day of a gap itself, but what I have noticed is that once you let the dust settle a little bit and you can just kind of monitor the gap and you're looking for a consolidation to go on over the next week or so and establish a new support zone, establish a new trading range. I like to look for narrow ranges after a gap. I like to look for inside days or even those doji patterns. Just something that says that the buying's stopped and everything's kind of just settled down a little bit, and that's when you want to really start paying attention to these stocks. And the next day that they start rallying out of those little narrow ranges and that period of just settling down is really when you want to start jumping aboard them. It could be for a swing or it could be just for a day trade. Again, this is focusing on swing trading. So again, just some examples here. I combine them all. So Facebook gapped up on earnings. I think this was late January. And it actually sold off that day. Again, this is why I don't particularly like to trade gaps, because I never really know whether people are going to be locking in profits on them or they're going to be adding to their winners. But the next day, you could see that the gap itself reversed quickly, very quickly, and that was basically a buy signal. These buys and sell signals too. This is actually another back test that I did, essentially waiting for the next day after a gap. So I just wanted to emphasize that. And you can see if you could establish this new support area right in here, so you basically can jump on board and you know where to put your stop, which is the whole key to this game. You know how much you should be risking and where you should be trailing your stop. And then it's a matter of just being patient and waiting. Here's an inside day. You had another inside day here. And once price started breaking out again, you could have even added to the position at above 63 or start taking profits into it, depending on your strategy and your comfort zone. GMCR, another one, gapped up on earnings. Immediately, again, established this new support area the next day. Inside day right here, and broke out the next day. Again, nice easy trade for. Looks like you could have bought at 111 and went up to 120, almost 9 points in one day. Jazz, pharmaceutical, biotech, strong sector. I mean, just a fantastic stock. Again, it gapped up over here. You have a doji, you have an inside bars, just kind of chopping around, but it's establishing this new support area right in here. and you could have bought that breakout there. Would have kind of chopped you around a little bit, but again, that's why we have these wider stops following the ATR, and you could have just had this breakout and you caught a nice extension higher. Recently we had Harman gapped up, probed, went higher the next day. Again, I'm usually waiting a few days later for the inside bar, the tight doji pattern. Waiting for everything to settle down. And this would have been a nice entry here. If you looked at a 60-minute chart, it looks like it would have been some sort of triangle pattern that you could have bought into, and it would have been a nice $3 gain there to start off your first entry. And then it's just a matter of trailing a stop underneath recent lows and maintaining the position going forward. Last slide here, just to some risk management tips. I know I've been giving a lot of tips here. Use as wide a stop as possible. This was told to me about 6 or 7 years ago. I went to a seminar, and there was a study done, and it makes perfect sense too, is that most people look at trading, they say, oh, I'm risking $1 to make 2, I'm risking $1 to make 5, and here's my target. And if you're going to find out that if you do that, unless you have this phenomenal system, you're probably going to be stopped out more often than not. However, if you actually flip that ratio and you actually said, I will risk $3 to make $1, you're going to have a huge percentage of winners. And yeah, you can take that one time you take the loss is going to probably wipe out the last 3 trades, but the percentages should completely be in your favor for high probability setups, especially now. So knowing that and then applying some of the techniques that I showed you, you should give yourself this massive advantage if you use wider stops. And wider stops does mean that you have to trade smaller size. So you have to really take a good look at your capital that you're playing with, or whether you're into options, and really kind of see what fits and what works for you. But for me, and on the Briefing Trader service, I think I use the widest stops out of all the traders' recommendations. I barely ever say I'm risking less than $1 on anything. Now, what I've also noticed is that I'm a big fan of scaling out. And I noticed that my risk-reward ratio improves once the price action starts going in my favor, rather than just taking that $1 gain completely and looking for the next trade. I'll take 1/3 of the position off, and then I'll take 1/3 off another $1 higher, and then I'll just let the rest of the position just ride for $9 or for $10 or whatever I can, as long as it's above a 20-period moving average or above the trend line. I'll just hold the position for 3 weeks, as long as it continues to act bullish in my favor, and that kind of fixes the whole concept of using a wider stop and the initial 3-to-1 risk-reward ratio. It kind of justifies it for me. Second thing I want to say here is just patient pays. Again, you can't approach trading as an exact science, especially technical analysis, and that's why so many people knock it, and it gets a bad reputation. Everyone thinks it's an exact science, and it's just not. It's all indications. It's all patterns. It's all just a matter of finding an edge. And the key is really to come down to just managing your own position once you're in it. We're going to highlight tons of setups for you on the trader service, and we're going to try to walk you through the actual trades themselves to squeeze the most out of it. But generally speaking, you have to have patience with a lot of these setups. Especially on this strategy here on these leaders, I would tend to avoid just jumping into weakness. Weakness is always good, but you want to wait for that follow-through day. You want to wait for that up day. You want to wait for that higher high. You want to wait for that reversal signal of sorts. Keep track of the 50-day moving average, especially on these leaders. They're definitely make or break lines. What I have noticed over the years is with a lot of these stocks, they will slide under the 50-day moving average but not necessarily break down. And in some cases, they will even fall off our focus list while they're trading below their 50-day moving averages. A few that come to mind are Facebook back in the fall when underneath this 50-day moving average. I think Salesforce.com, CRM, fell below its 50-day moving average. Cognizant fell below its 50-day moving average. That's CTSH. But they didn't actually sell off continuously after they did so. They just managed to start consolidating and forming new bases. So even though they weren't on our focus list, these were former leaders that, in my book, didn't really correct and significantly, and they were just kind of reestablishing themselves. And I keep track of those. And when they start rallying out of those bases and start getting back above the 50-day moving averages, they're like new stocks all over again, and you can just jump on board. I think I bought Facebook around $57, I want to say, or $51 back in November. I don't have my charts in front of me, but when it was rallying back above the 50-day moving average from one of these patterns, and I'm still holding it, just riding the trend higher since. So that's just another thing to keep track on. Triple D was one that broke down below its 50-day moving averages, and selling just really has gotten really aggressive. Again, this is just an avoid stock for right now. I wouldn't even go near it. Herbalife was one that also broke down below the 50s. I mean, it's just a list of them. And you're going to see on the weekly updates, I do tend to reiterate this a lot, and I do show examples of why they should be avoided or at least monitored, going forward. The other thing too is, if you're into options, these are leading stocks, usually in uptrends, so covered call strategies work very well. That should wrap up the seminar here. Just as a side note too, before I answer the questions and go to Q&A, do not run out and start buying every RSI 5 oversold level in these leading names. I can guarantee you're going to lose money. Seriously, don't think this is some sort of holy grail. Like I just said, I can't stress that enough. Their technical indicators are just indicators. Use them as that. Use them for identifying the low-risk opportunities, especially in the strong sectors, especially in the strong stocks. And then when you get that confirmation that everything's resuming higher, when the market's going higher, the sector's going higher, that's when you really want to try to jump on board, establish your risk, and then scale out of profits as the stocks move higher. Keep it as simple as possible. I mean, this stuff isn't rocket science. This is if the simpler you make your strategy, I could almost guarantee you that you're gonna find success with a lot of your trading, a lot of your setups. So moving along to the Q&A. Yes, this is recorded. We do have a Briefing TV channel on YouTube. So we've done tons of webinars. You can just go to Briefing TV on YouTube, and you will see, emerging growth focus lists, analysis, there's so many things from swing trading, day trading, how to deal with earnings season. There's education videos there. So yes, it will be recorded. It should hopefully be uploaded to the YouTube Briefing TV YouTube channel by this weekend. Is the volume the upper indicator on the top of your chart? I do not use volume. I look at it occasionally, but as you know, I'm focusing on what I define as blue chip stocks, which are the leading stocks. So in my mind, and our scans, our proprietary scans, usually have minimum volume requirements, especially on liquid momentum and value. I think it's of like 500,000 or 1 million shares. So I just know the volume's there. And again, I'm not moving markets by any means. So liquidity, as long as I know the liquidity is there with volume, I'm not a volume guy. I'm just not. And I think the analysis of volume, seeing price action rise on low volume or breaking on breakouts, yeah, I've done all that. It's very difficult to interpret. That's all I can say. Volume, to me, there's always a buyer and a seller for every transaction. So volume just says the buyer is bigger. If you have a better way of doing it, whether you're using on-balance volume or accumulation distribution lines or something like that, shoot me an email. I would love to, if I could find a better edge, that'd be fantastic. The focus list, yes. So if you go to the drop-down menus on our site itself, I don't want to pull up an actual website here because I might actually slow down everything. But there are drop-down menus, and if you look at the drop-down menus, you're going to see liquid momentum, you're going to see emerging growth. The value focus list is under the stock ideas column headline, and these are all updated weekly. And you can also just type in the tickers, value in the ticker search in the top right-hand corner of the website, value, LQDXX, or GROWX, GROWX. And those are going to bring up all the archives and the recent articles and anything we pointed out. Shorting. Do I ever short leaders? I do on the trader site. I don't want to focus on that for this webinar. You know, I look for specific patterns. Failed breakouts is usually what is my main go-to pattern on shorting these liquid momentum names. I also tend to short them usually when they're dropping below the 50-day moving averages, and you know, depending on how aggressive they are and how I feel like the market and the sector. But generally speaking, you do not want to be shorting the upper Bollinger Band on these names, or if they run up 5-6 days in a row, you can short them, but you know, again, somebody should be buying them on the dips. They're just the inherent bullish nature of these stocks being leaders. That somebody's always going to be on the dips, ready to bid it higher. Yeah, parabolic moves. I wouldn't even short them. Parabolic moves, they tend to, you know, you got to wait for confirmation. You know, a parabolic move can just turn into a range. It doesn't necessarily have to be a full 180 reversal. Can I talk about the signals again? Sure. The signals a bit again. Are really just kind of basic technical analysis. You know, RSI, stochastics. You know, just take your pick. Even a MACD. You know, take your pick of technical signals, or just get a moving average. Keep it simple. That's all I can tell you, and just focus on what they're telling you. Don't take their signals per se. Focus on what they're telling you. Get your order ready. Get everything established ahead of time. You know, and if we try to aid you along on the trader service site to do all the work, a lot of work for you. But hopefully you can see what we're seeing. So when you see comments on the trader site, especially from me, if you pull up a chart and look at it and you don't see it, don't take the trade. It's that simple. Hopefully I explained myself in the comment enough, but if you can't see it because you're just not experienced enough, really just don't take the trade. There's always going to be another opportunity coming along somewhere else. Let's see. For software, I have eSignal as my main go-to trading software, but I also use StockCharts.com, TD Ameritrade for back testing. They have a strategy desk, I think it is. But there's also trade stations out there. I don't sponsor. I'm not a sponsor for any of these. I don't get any money or paid for saying their names. But you can pretty much go anywhere and you know, on the web, maybe find some charts, and just as long as you can draw a trend line, you're pretty much good to go. So do I go all in on my initial position rather than scale in? But I scale out. Yes, that's my tendency. I definitely go in all in and scale out. You can, you can scale in. Maybe that's a better strategy for you. Maybe when you see RSI 5 oversold on one of these leaders, maybe you want to initiate a position of, say, you know, a quarter position or a third position, 100 shares. And then if it drops another $1 the next day, you buy another 100 shares. You know, then you buy another 100. If it goes down another $1 against you, yeah, that's definitely a strategy to deploy. I don't particularly like that. Again, I prefer to wait for I prefer to just keep those stocks on my radar, and then when they start to turn, I'll start initiating positions, and then just establish my risk. But again, it just depends on how much effort and time you want to put into it. How big is your bank account? Again, these are the kind of things you have to kind of self-assess before you should even be placing a trade, of how you want to first approach it. And then you should also have your exits planned out as well. Again, I usually like to use an ATR. So when an ATR, you know, if it's $2 and price is moving $2 in my favor, usually scaling out a third of my position already, and then trailing a stop. All right, so I took Boeing, recently broke down below 50-day moving average. Was that just logic, or was it the RSI oversold? So it was a combination of things. I really like the aerospace sector. I saw the peers Lockheed Martin, Raytheon, General Dynamics, plus the ETFs of the aerospace sector were holding up pretty well. And I believe Boeing was just breaking down real aggressive. It came into that 120 level that I was just looking back on the chart. I liked the level. Everything was oversold on it. I didn't have to look at RSI 5 to tell me that, just from the way it was dropping. So I think the, was it the 200 or the 100-day moving average was also around that vicinity. So there's just a lot going on around the 120 area. And the fact that it was a leader, you know, when a former leader gets absolutely smoked and like drops significantly, 15, 20% in such a short time frame, there's going to be a bounce back period almost always, unless the company's going out of business or just horrible. So Boeing was really just kind of a trade that I really liked at that 120 support area, and fortunately it's had a nice little bounce here over the last week for about I think, what was it, $6-7 gain we've had. Let's see. Have we done this for short candidates? You know, we tried doing it for short candidates, and you know, shorting is a whole different beast by nature. We have to wait for the next bear market, I guess, to roll that out. We've been kind of toying with that one as a long-term side project. You know, there's just a lot going. Shorts are tough. There's always somebody that finds value in a stock price going down, no matter how bad the fundamentals are or how bad the company's outlook is. But we're working on that. But for the most part, we found it easier just to stick with leaders. Briefing TV, yes, that's the channel name under YouTube. If you just look for briefing.com or briefing, you're probably going to get something else. Try searching for Briefing TV, television. I believe that is it. I want to kind of wrap it up here. Let's see. If you have any specifics about like trading options or you know, how to interpret talking about the capital invested and what's your percentage you're putting up for a particular trade, you can just shoot me an email, or you can just contact sales, or you can write to swingtrader@briefing.com. That's swingtrader@briefing.com. And I'll try to get to those specific details, or at least steer you in the right direction for certain percentages and different types of option strategies. But generally speaking, I hope you learned something. I hope I gave you a new technique. You know, things to look for, especially among these leading sectors and leading stocks. And good luck to you. Thanks a lot.